Ever look at a company's balance sheet, see that huge number next to assets, and just kind of nod along? Well, today we are popping the hood. We're going to find the real story behind that number, and trust me, it's a tale of promises, physical products, and a whole lot of educated guesswork.
So let's kick things off with a puzzle. Imagine a company announces a record-breaking sales quarter. The revenue numbers look amazing, but what if the actual cash hasn't hit their bank account? What is that sale really worth at that moment? That little gap right there between the handshake and the cash is exactly where our story begins.
All right, here's our game plan. We're going to follow the entire life cycle here. We'll start with what is basically a corporate IOU. Then we get into the fun part, trying to guess who's not going to pay up. From there, we'll talk about how companies can get cash out of those invoices early. And then we're shifting gears completely from the financial promise to the actual physical stuff, the inventory, the art of counting it, and, oh yeah, what happens when it all goes wrong.
Okay, let's dive into that first piece, the corporate IOU. See, when a company sells something on credit, they don't get cash right away. Nope. What they get is a promise. And in the world of accounting, that promise has a name: accounts receivable.
So, accounts receivable, or AR for short, is simply the money that customers owe a company. It's a huge asset on the balance sheet, for sure. But here's the thing you absolutely have to remember. It's the promise of cash. It is not cash itself. Not yet, anyway.
And here's where we hit the real world. Because, let's be honest, not every customer pays their bills. It's just a fact of life. Companies know this, and accounting rules actually force them to plan for it. They're not allowed to just cross their fingers and hope for the best.
So how do they plan for it? With this clever little thing called the allowance for credit losses. Honestly, the best way to think about it is like a rainy day fund, specifically for unpaid bills. It's what's called a contra asset, which is just a fancy way of saying it's an account that reduces the total receivables, bringing that number on the balance sheet down to a much more realistic level.
Okay, so how do they come up with this number? It's an estimate, after all. Well, there are two main ways to do it. The first is the income statement approach. This one looks at all the sales you made in a given period, say this month, and estimates that a certain percentage, like maybe 2%, will probably go bad. The other way is the balance sheet approach. This one looks at the entire pile of IOUs you currently have and says, of all the money owed to us right now, we think we won't collect, say, 6% of it. Now, that balance sheet approach can get really sophisticated. Companies use what's called an aging schedule, just like this one here. And this is so smart. Look at the percentages. If an invoice is fresh, less than 30 days old, they only expect a 2% loss rate. But once that same invoice is over 90 days past due, whoa, that jumps all the way to 20%. It's a really clear picture. The older a debt gets, the less likely you are to ever see that money. So you've made a ton of sales. Your accounts receivable is looking great, but you have payroll to make next Friday. Your customers, though, they don't have to pay you for another 60 days. See the problem? This cash flow gap is a massive, massive headache for so many businesses. Well, there's a solution, and it's called factoring. The easiest way to think about it is like a payday loan, but for your company's invoices. You basically sell your stack of IOUs to another company, the factor, at a discount. They give you a big chunk of cash right away, and then it becomes their job to chase down your customers for the full amount. Let's just walk through the numbers so you can see how it works. Let's say you've got $100,000 in invoices. You hand them over to the factor. Right off the bat, they take their fee, we'll say 2%. So that's $2,000. Then they hold back a reserve, maybe 10%, just in case some bills go bad. And of course, they charge you interest on the money they're advancing you. At the end of the day, that $100,000 promise of future money turns into about $85,000 in your bank account, right now, today. So why would any business do this? I mean, you're giving up a nice chunk of change. Well, for a lot of companies, it's a total lifesaver. You get your cash immediately, which can solve huge cash flow problems. You might even be able to get rid of your own collections department, saving you time and headaches. And, this is a big one, if you sell the invoices without recourse, all the risk of customers not paying, that's now the factor's problem, not yours. All right, so we've followed the journey of the financial promise. Now let's hit the rewind button and talk about the actual thing that created the promise in the first place, the physical product. This leads us to the second huge asset we're tackling today, inventory. Inventory is, quite simply, all the stuff. It's the stuff a company has on its shelves to sell, the stuff it's currently making, and even the raw materials it's going to use to make future stuff. For a store like Target, it's everything in the building.
For a car maker, it's everything from bolts of steel to the brand new cars sitting on the lot.
Now, companies have two main ways of keeping track of all this stuff. The first is a perpetual system. Think of this like a live running tally. Every time an item is bought or sold, the inventory records are updated instantly. This is what a car dealership or a jeweler store would use. The other way is the periodic system. This is much simpler. They just do a physical count every now and then, say at the end of the month, to see what they have left. Think of a small corner store.
But that physical count, it sounds so simple, right? Just count the boxes. But it is way trickier than it seems. The real question isn't what's physically here. The real question is, what do we legally own on the exact day of the count? And this is where it gets messy, because you have to count things that aren't even in your building. You might have to include goods that are on a truck halfway across the country, and you definitely have to include any goods you have out on consignment. That's stuff you own, but another store is selling on your behalf. The golden rule here is ownership, not physical location.
So, how in the world do you know who owns that stuff on the truck? It all comes down to these three little letters. FOB, which stands for free on board. If the terms are FOB shipping point, the buyer owns the goods the second they leave the seller's warehouse. If the terms are FOB destination, the seller owns them all the way until they're safely delivered to the buyer's doorstep. That tiny little phrase determines everything. And now for the grand finale. After all of that complexity, what happens if the count is just plain wrong? This isn't a small problem. A single mistake in counting inventory creates a financial ripple effect, a cascade of errors that can make a company's financial statements misleading for years. So let's follow the dominoes. Let's say in year one, a company accidentally overstates its inventory. They count too much. Well, because their books think there's more inventory left over, the cost of goods sold for the year is artificially low. Lower costs mean higher profits, so net income is artificially high. This makes both the inventory asset and the company's retained earnings look bigger than they really are. A simple miscount makes the company look healthier and more profitable than it actually is. But here is the absolutely wild part. In year two, the error automatically reverses itself. That overstated ending inventory from year one becomes the overstated beginning inventory for year two. This makes the cost of goods sold in year two too high, which in turn makes the net income for year two look too low. So the results are misleading for 2 entire years, even though by the end of year two, the error has technically washed itself out. Crazy, right? So here's the bottom line. When you look at assets like receivables and inventory on a balance sheet, you are not just looking at numbers. You are looking at stories. Stories that are built on management's best guesses, on critical decisions about timing and cash flow, and on the very real-world challenge of tracking every single thing a company owns.
So the next time you see that total assets line, I want you to pause. Don't just see the number. Ask yourself, what's the story here? What estimates, what risks, and what decisions are hiding behind that figure? Thanks for digging into the details with me.